Good morning and welcome to Real Estate Economics webinar series. Real Estate Economics is a leading provider of residential market consulting services and online research tools. Real Estate Economics webinar series covers a variety of topics of interest to the home building, land development, and lending industries, and interested participants in related public and private sectors. I'm John Mulville, Vice President of Consulting at Real Estate Economics. I'll be presenting today's overview of the Salt Lake City, Utah MSA. I'll provide contact information at the end of this webinar if you have any questions or topics of particular interest. You can always find Real Estate Economics webinar schedule on our website, www.realestateeconomicsallspelledout.com. To watch our past webinars or to see the available webinars for the last few weeks and months, access our YouTube channel at www.youtube.com/realestateeconomics. At the top, click the link labeled All, ALL, and it will list our past presentations. From there, you can select a presentation that you want to watch and view that at your convenience. Jobs have turned into such a big issue in this economy and in this current political environment that we'd like to look at jobs, see how this area has produced jobs and progressed in the last few years. Notably, this area had a huge surge in employment in the late 90s and early 2000s. This market area has a substantial tech sector that's recognized locally but not necessarily nationally. So we saw a lot of job growth in the early 2000s. The dot-com bubble dropped that total employment here, total non-farm employment, down a little bit into the middle of the decade, and then the market rose substantially in terms of jobs in 2006, 7, and 8. Now we've fallen back a little bit here because of the recession and subsequent slow growth period, slow economic recovery that we're currently experiencing. This has significant implications for the housing sector, which we'll talk to briefly here. When the job market is steadily growing year to year, there's a very strong correlation between the creation of a new job and the demand for a housing unit. When that job recedes, as it has currently, the housing stock essentially is larger than the employment base, or too large for the employment base, and that produces slack demand and price pressure that many market areas have been witnessing over the last several years. If you can see in this market, the peak job years were 2007 and 2008. We'll return to those peaks in 2013 or 2014, and that will really help distribute demand across the region in a much more efficient manner. When the jobs are slightly degraded as they are today, the housing market opportunities tend to be location-specific, product-specific, and targeted at certain buyer profiles. Here's 12-month changes in jobs for this MSA. Again, the 1990s were an excellent period. You can see the downtrend in the dot-com bubble burst, 2002 and 2003, and then a quick rebound in the middle of this last decade associated with construction and related financial jobs. And now we've had a considerable tail-off in growth through 2009 and 2010. This market is actually a little bit late to the recession compared to many markets regionally and nationally, with good job growth in 2007 and even positive job growth in 2008. Many market areas were already suffering in 2008. This area shows a quick and noticeable rebound during the course of 2011 and out through the forecast period. It's really going to take the entire forecast period to recapture those jobs that have been lost in the recession and subsequent economic adjustment. This area has benefited from extremely low unemployment on a historical basis. You can see these figures are annualized, so we recognize current figures may vary. Full year estimates on an annual basis here. You can see the surge in unemployment during the dot-com bubble burst period of 2002 and 2003, and then a drastic reduction into 2006 and 2007. We've observed in many markets that areas that had a dot-com bubble burst were really not positioned financially, psychologically, and for several other reasons, to immediately have another housing bubble come along. So the fact that this area's had a lot of tech jobs has lessened the depth of the subprime problems in this area, unlike many of its neighbors in Nevada, Arizona, California, and surrounding states. You can see over our forecast period, it's going to be a slow draw back down to normalized unemployment levels in this market. One of the things that helps the overall supply picture here is very, very low permits. You can see the permits between 2010, 11, 12 are all the lowest over a 20-year period going back all the way to 1991. In 1990, the job base here was about 35% smaller than it is today, so we're producing homes at a level that suits a much, much smaller job base, and ultimately that will help realign supply and demand in this area. This slide shows the annual change in housing supply. Again, let's come to the 2010, 11, 12 period. These numbers of adding just 3,000 or 4,000 homes per year to the supply, if you put that into perspective, every year there's numbers of units taken out of circulation for conversion to commercial uses, larger scale reuse where homes are knocked down and commercial centers are put there. A certain number of homes are declared substandard or no longer occupied residentially. Many of the older homes in this area are approaching the end of their economic life and have lost their ownership appeal, and in many cases their rental appeal. So the bottom end of the housing stock in any market, not just this area, tends to be very poor and not nearly as functional and as appealing as newer homes. So we're really adding so few units here that it's barely able to replace the units that we would consider below par or substandard. This chart shows mortgage interest rates going back 30 years. These are national averages, full year annualized estimates again. If you've heard our past webinars, we've spent some time talking about the super cycle in interest rates. Not just mortgage rates, but U.S. interest rates in general have been in at least a 30-year super cycle going back into the 80s with a steady downward trajectory. This trajectory looks like it's at least in a bottoming phase, and we've got some projections for higher rates over the next few years now. Any cycle that plays out over 30 years or affects markets as large as the mortgage market and as large as the U.S. Treasury market is going to make a lot of noise before it changes direction. Interestingly, it seems like we may be seeing some of that noise today. And during this week, we had a poor 10-year note auction yesterday. This morning, we've got a 30-year auction, and we've seen quite a bit of backup in the 30-year Treasury bonds. So, as we've mentioned, this market's going to squeak and grind and make all kinds of chatter before we reverse and start to see higher rates. But that's a process that's probably beginning to play out. We think that's probably at least a 6 to 12 month time horizon before we're all clearly certain about the direction of rates in the coming years, but we think it's a gradual trend upward. That's actually a positive in many senses for the housing market, since it will help to keep a lid on price appreciation and will help keep homes generally affordable in the forecast period. I'd like to talk about household income growth. Incomes in many parts of the country, this being no different, have grown relatively slowly in the past few years. You can see at the right-hand side of the chart the 12-month change figure. In 2009, we're down to 1%, with some slow figures in 2011, 2012. If you take these numbers and factor in the possibility that there's no extension of the Bush-era tax cuts and take-home pay is significantly reduced by higher rates, that has the potential to affect the mortgage market and the housing market. By calculations we've seen, a family of four earning $60,000 a year will have $2,160 less take-home pay in 2011, unless the income taxes are extended. That's really reduces your take-home pay by about roughly $100 per 2-week period. So with so many families living on the, right on the edge, paycheck to paycheck, if you will, trying to draw down their debt, a big tax increase at this point has a potential to significantly impact the economy, the housing market in particular, since a loss of take-home pay of that magnitude really translates into about a $30,000 decrease in residential mortgage borrowing power. That's part one today. Please join us for the second part of today's webinar.